Greetings. Happy holidays and welcome back to the Rose Bros podcast. This episode, we were joined by Mike Timms, Vice Chairman of MATCO Investments, a private investment holding company. Mike Timms joined MATCO after 33 years at Peters & Co. Limited, a Canadian investment firm specializing in energy, as Chairman, President, and CEO. He holds a Bachelor of Commerce degree with distinction from the University of Calgary, an MBA from the Harvard Business School, and an honorary Doctor of Laws degree from the University of Calgary. Recognitions of Mike Timms' business achievement and community service include, among others, a member of the Order of Canada, the Founders Award from the Fraser Institute, the Woodrow Wilson Award from the Canada Institute for Corporate Citizenship, a Lifetime Achievement Award from the Oil and Gas Council, and induction into the Canadian Investment Industry Hall of Fame. Mike Timms is the immediate past chairman of the National Gallery of Canada. He previously served as the chairman of the Canadian Investor Protection Fund, the Investment Dealers Association of Canada, the United Way of Calgary, and West Island College. He has also served as the director and governor of a number of other organizations. We sat down for a smooth cup of Rose Bros coffee and discussed lessons from 30 years in energy investment banking. I hope you enjoy the wide-ranging conversation, and happy holidays and Merry Christmas. Enjoy. This podcast is sponsored by headracingcanada.com. Looking for high-performance ski gear this winter? In partnership with four-time Olympian Manny Osborne-Parody, headracingcanada.com is offering the lowest prices possible through its online storefront by passing brick-and-mortar savings on to customers. Check out headracingcanada.com for more info and get your high-performance ski gear for the upcoming season.
So it feels better as a conversation. So,
all right. Well, why don't we start then?
Away? Yep. Go ahead.
Recording. Mr. Mike Timms, you are the Vice Chairman of MATCO Investments. Thank you very much for doing this.
Thanks a lot for having me.
Before we start, I think we have to do a quick shout out to your son-in-law and Marty Staples for connecting us. Yeah. Thanks a lot.
That's Brad Marcotte's my son-in-law, and he and Marty were the ones that introduced us. So that's great.
I know your time is valuable, so I appreciate your time as well.
My pleasure.
You are probably one of the most interesting people I've ever met.
Oh, I hope I don't prove to be a disappointment to your listeners. So, there.
Not many people I know who are on the board of CMH know Leo Grillmar, Hans Moser, have a Harvard MBA, whereas the CEO of an investment bank, collect fine art, philanthropist. I really appreciate it. You remember the day you got into Harvard?
I do vividly, and I was out of town, and you never know which schools you'll get into. I'd applied to a bunch of graduate business schools and law schools because they all have the same deadlines. And so anyway, I previously decided if I got into Harvard Business School, that was my top choice. My mother phoned me up and she said, well, you got accepted to Columbia today. And I said, oh, that's a good, very good school. And then she said, oh, and you also got into Harvard, knowing, of course, what I was going to say, which was, I'm definitely going. We're sending the money right now, and I will be there. That was a joyous day. So.
Did you always want to be an investment banker?
I was interested in investments, but I don't think I knew whether or not that opportunity would be available to me until I started interviewing for summer jobs while I was at Harvard. And I was fortunate to get an offer from Merrill Lynch Canada and work with some really exceptional people that summer. And of course I was interested in finance and investments, but that really reinforced it.
You came from Harvard and you came back to Calgary. You led the investment banking group at the time at Peters & Co.?
Well, there's another interlude in between. So I spent a great summer at Merrill Lynch between my 2 years at Harvard, and I felt a little guilty accepting an offer from Wood Gundy Limited after Merrill Lynch had been so great to me and had kindly offered me the chance to go back. But Wood Gundy Limited was the powerhouse. This is while it's still a private firm, long before it was bought by CIBC. It was the place to learn the most, and it had the largest market share and the senior company clients. I decided to accept their offer and went to Toronto. I guess I was in Toronto close to a couple of years, but during a large percentage of that time, investment bankers travel a lot. But anyway, I ended up being the associate on a lot of the energy and utility files in Alberta. I was the only born Westerner in the investment banking group at Wood Gundy Limited in Toronto at the time. So I was kind of a logical fit for that. And I loved coming out and learning about those industries. And that was a great time and a great learning experience. I've been thinking about this a little bit lately in the context of FTX and Sam Bankman-Fried. And, one of the things that he missed was the mentorship and all of the folks teach you the rules and cause you to go through the courses and get at least the grounding. And so you think about the benefits of being at a firm like that. One of them is just to have so many great people to learn from.
So you got to know everyone in Calgary in the finance scene, and I guess it was Rob Peters who convinced you to come back here?
Rob Peters and a couple of his partners. I actually first met Hugh Osler and then later met Rob. But anyway, they invited, I was at Wood Gundy Limited. I was very happy. I wasn't looking to move. A couple of people had given my name to them, and they were looking to start an investment banking group within what was only then about a 12-person investment firm doing institutional and retail sales, energy specialized, of course, and had one analyst, but they wanted to start an investment banking group. And I think it was probably difficult for them to find exactly the right fit to do that. And I sometimes say, well, probably I didn't know what I didn't know when I went there, although I kind of look back and say, well, the time at Merrill Lynch and Wood Gundy at least gave me enough of a grounding to maybe avoid some serious mistakes. And so I started the investment banking group at Peters & Co. Limited. A few years later, they made me Chief Operating Officer of the firm, Executive Vice President, Chief Operating Officer. And a few years after that, I became president of the firm. So I was, in essence, then the second president of the firm. So,
did your Harvard classmates think you're going to the end of the earth?
I would say they didn't actually have that feeling, because I don't think they had the distinctions in their minds of all the Canadian firms and who did what and everything. But there were other people who, when I left what was obviously not a senior role, but I was at the most prestigious, most established Canadian investment house, to go to, a relatively upstart wave making shop, which was trying to establish a strong position in the energy sector. There were a number of people, including my own father, who thought I needed my head read to make that move, but it worked out.
Obviously worked out. Did you view it from an entrepreneurial lens?
I did. I think I sensed the magnitude of the opportunity very quickly. The energy sector was on wheels right then. I count in my history about 8 cyclical downturns in the 40 years I've been doing this. So roughly twice a decade, energy seems to get a kick in the pants and turns down. At the time I had to make that decision, things were really on wheels, and I could see the opportunity, and I could see the potential in Western Canada for incremental oil and gas production and everything that could bring.
Because originally you're from Calgary.
Yeah.
It wasn't like you were literally going to the North Pole from Harvard.
No, exactly. I was born in Calgary. I've lived in Calgary the largest share of my life, although I've done stints as a kid in Winnipeg and Regina, and then also in Boston for Harvard, Toronto with Wood Gundy, and then back to Calgary again.
One of the most important parts of an entrepreneur or business owner is to have skin in the game. How much of that did you have to put into the company when you got going, or was it your time, or how did you view it from that perspective?
Peters & Co. always functioned as a partnership. Clearly in the early days and when I joined, it was dominated by a larger-than-life character in Rob Peters, who probably the best salesman a person could ever meet, but who also had the sense that he needed a bunch of partners with complementary skills and a sense himself that he didn't have maybe the risk aversion that was needed, and he needed people, that were being analytical and careful about how and what we did. So that ended up being a great combination, and a few folks who particularly have been highlighted in the growth of Peters & Co. I always am quick to say it was really a fairly decent-sized group of partners, which changed over time, who created the success of Peters & Co. And it wasn't any single one of us, but rather a whole bunch of people working collaboratively and in a complementary way.
One of the biggest, I guess, prices you probably had to pay was your time. You coming from Harvard had a good network, and Wall Street must have been tempting, like we talked about over lunch in the 80s and whatnot. Did you ever think about going to work on Wall Street and really ride the wave of banking?
I did. And I had a few opportunities in the U.S. when I finished at Harvard, but in the investment banking sector, I was really young in my class at Harvard. And so I was reluctant, if I could go to the top firm in Canada, to go to a lesser tier firm in the U.S. And frankly, I was still just 23 years old when I got my MBA from Harvard. So I was young to go into, any of the bulge bracket investment banking firms. I obviously had opportunities with Wood Gundy, Merrill Lynch, and a bunch of others, but I sorted it all out. And for me, I thought I could learn the most, and it would have the most future applicability if I went to, a serious firm in Toronto, and that's what I ended up doing.
You were at Peters & Co. for, I think it was 30 years, roughly?
33 years, yeah.
And you were CEO for 20.
Well, I was either president or chairman, because I was chairman for a good chunk of that time, too, for 24 of the 33 years. One of the things that we always sought to do at Peters & Co., and the firm still does, too, is to ensure that the next generation has visibility to owning and running the place, and that, we don't get any one group of senior partners who dominate the place forever. And so part of the mechanism for that is a requirement that all the partners start to sell out when they hit 55, and in effect they've sold all their equity at the age of 59 or 60, depending on birth date. And the same kind of applies with the senior ranks, which is, it seems to work better if the same person doesn't hold the job forever. But for me, it worked well to transition to chairman. And I was always very careful once I moved to chairman to make it clear, both internally and externally, the next CEO had the ball and that I was there to help him, that I wasn't there to supersede or to be another court of referral or something like that on decisions, that the CEO was in charge, and that, and moving to chairman in that way, I think tends to work relatively well. And you see many companies where the president and CEO moves to often what's called an executive chairman role, and it doesn't work well because there's too much confusion or lack of clarity over who's really running the show. And often those two people end up clashing. You see it recently at Disney as an example, where the chairman and the new president and CEO just collide, and that can have a whole bunch of drivers as to why that occurs. So I felt lucky that not only that I was able to build such a long career there, but it actually felt appropriate too. Like I always used to say to my partners, I never want to be the person who overstays, and one of the reasons we designed the system we did was to sort of mitigate or hopefully eliminate that problem. So I never wanted to overstay, and it felt like the whole time frame I was there was kind of the natural progression. And then I had said when I started into the sell down, so that the firm could plan, that I intended to stay the full 5 years. But at that time, unless there was some reason not to go, I would go and do something else, and not in conflict with Peters and Co., but rather that I follow the system and the pattern that we had set up. And I will mention, I had a number of investment firms say, "Oh, well, now that you're done there, why don't you come and work with us?" And I said, "Well, it just doesn't feel right to me to help to build a firm for 33 years and then to go and compete with it afterwards." So I said, "Thank you, but I'm going to do something that isn't in conflict with the business that I was hopefully helpful in building." So.
I remember asking you why you didn't leave Peters & Co. earlier when we originally met. And you said part of it was because you couldn't picture yourself competing with the business or going, after putting all the time in, leaving the people you led. So you obviously had your soul, or whatever you want to call it, invested your time in the business.
I think the way I perhaps described it was, after a certain period of time, you start to feel really responsible, in the sense that part of how a firm gets built is that the next partners and the next young associates and analysts, they have to buy into somebody's plan and vision for the firm. And then, that also didn't feel right to me. The notion that okay, well, you help to build something and then jump off to go somewhere else after people have shown the faith of joining in and wanting to be part of it. So I would say I kind of reached the point where I just thought, first of all, not the right thing to do to go somewhere else, and secondly, probably then the place that I was going to be until that retirement that we just discussed. So
sometimes CEOs come and go. Maybe they're good at sitting meetings or doing PowerPoint presentations, but when they become CEO, they don't last long. You lasted for 20 years. How come you think you lasted that long?
That's an excellent question, by the way. But one of the things, and the 24 years included both president and chairman. But anyway, one of the things which I think was, it's not my style to try to make unilateral decisions. And we had an executive committee always that functioned very well, and where there was good discussion and debate, and where, when I was chair of the National Gallery of Canada, the CEO of the National Gallery said, "I've never had a chairman before who actually encourages the other side of the debate to come out." And I said, well, it's part of what I learned in the investment bank, because I used to say to my colleagues, well, if you have qualms or concerns about a deal we're about to do, I'd far rather hear it today before we commit our capital and take the risk than I would you come back 2 or 3 days from now and say, "Oh, I didn't think that was a good deal the firm was deciding to do." So I always tried to bring into the decision making the fact that there might be another point of view, and also that it should be more or less a consensus. That doesn't mean it has to be unanimous every time, but more or less a consensus. The other thing too, because you can't have every single minor decision become a committee decision. Mm-hmm. We sort of developed a way of thinking about what was a decision that the CEO or the chairman or the vice chairman could just make. And generally what it was day-to-day decisions, that, especially ones that were reversible or didn't have big consequences. One person could make those and we drive on, but we never did anything significant, whether it be committing capital or making an important new hire or anything like that, without having some conversation about it and making sure that, generally that there was buy-in to what we were doing.
Did the crown ever start to lie heavy after working with people swimming with sharks for 20 years who basically wanted your job?
It's funny. One of the things which, and I know there are investment banks that have exactly that phenomenon. I know a fellow at one of the big New York investment banks, and which has had a reasonable amount of turnover. And I said, what causes all that? And he said, small tank, many sharks. But we actually were very lucky, for the most part, attracted people who fit the culture and who fit that decision-making process, and were not trying to be a one-man team. And so therefore, I never got the feeling of significant internal tension. And partly too, it's hard for somebody to say the process isn't sound if their views are being solicited and the opposite side of the question is being seriously entertained, before decisions are made. So it was partly that, but I would say many firms, in not just investment firms, but in lots of other industries and professions, profess teamwork, but they don't actually encourage it in the right ways. And one of the ways in which teamwork gets discouraged is if the compensation structure doesn't reward being a team player, but instead rewards the player who can take the puck from one end of the rink all the way down to the other end without passing. If that's the culture you want to have, you'll just end up with a very different result, and you'll end up with a different kind of folks in it. But so I kind of feel like we attracted people who thought in a common way about how to approach the business and how to approach decision making and that kind of thing.
Where do you think you picked up the most financial acumen through the years? Was it just through experience or through mentors, or do you have a time when your knowledge really seemed to jump? Was there a person, or?
I would say all of the above, I guess. Harvard Business School for me was a life-changing experience. And one of the reasons why was because I was relatively young, but with the case method, really strong, distinguished professors and classmates who themselves had a wealth of experience. In a 2-year span, you pick up a lot of things out of that. And then I was really lucky with the mentors I had at Merrill Lynch and Wood Gundy Limited. Very, very lucky to have those experiences. When I first went to Peters & Co., I didn't have quite that same number of references in terms of the investment banking part of the business. And so I found I had to read up extensively and cultivate a network of other contacts, so that I was staying in the flow information wise.
You just learned slowly through the years.
I sort of feel that, that there are many elements of business which are essentially common sense, and also I think the people with whom you deal in business quickly get a sense of where you are on the spectrum of trying to craft something that's fair and balanced for everybody, where everybody walks away happy, or whether you're going to play the side of every point of leverage that you could get and, bear the consequences of the fact that the other party may agree to do the deal, but isn't happy about it in the end. And I always kind of felt like I was trying to represent clients well and represent our firm well, but that there was a balanced path that was fair, more likely to be fair to everybody. And then I think actually you end up getting more business if people think of you in that light, because they think, oh, well, those are the kind of values we have. That's the kind of person we would like to have representing us in our transactions. So.
When things started to really pick up in the late 80s and the 90s and early 2000s, was it hard to do quality deals, and maybe you had to turn down business just to keep your reputation?
Yeah. And when I first became Chief Operating Officer at Peters & Co., which was 1986, one of the things Rob Peters said to me was, well, we have to figure out how much we're going to pay you for this new role, which was more complicated than being head of investment banking. And I said, well, I think we're going to be able to figure that out so it works for everybody. And if it doesn't work for everybody, well, then one way or the other, we'll stop doing it. But I said the more important thing to me, if we were to build a firm that has a strong reputation, is that I would like to have a veto for quality reasons on anything that we do. And I said, I know that's a lot to ask in an entrepreneurial kind of organization, but I've seen too many other firms where quality gets out of control and then it tarnishes the reputation of the entire firm. And so that's the most important thing. I often thought I didn't really ever have to use the veto. However, the fact that I had it enabled me to influence how we did things, or whether we turned down some kinds of business or dealing with some people, because it just wasn't going to do the right things for our reputation and the quality of the work we could do. And so I thought that was a really important way to look at things.
If I'm correct, originally investment banks were always partnerships. The original New York investment banks were always like that partnership style. Then they went public and things kind of changed. It sounds like you guys built Peters & Co. on that original model with the partnership.
And you were absolutely right. There's very few that still have the original structure. And I still see many merits to that partnership kind of structure, because everybody around the table votes differently and thinks differently when his or her own capital is also at risk, and they have, it's not all just upside. And somehow, as we got the share ownership of investment banks separated from, in effect, the managers and employees who were participants in the compensation pools, it changed behavior, because if you don't, almost all of those people also are shareholders too. So it's not quite as dramatic as I'm about to describe it. But if the bulk of your economics comes out of the compensation pools and not out of being a shareholder, and your risk of loss, if as a shareholder, is nowhere near as your potential of gain in compensation, it tends to cause everybody to take a lot more risk. And it's, I think, in part why you start to see more blow-ups in investment banking context, whether it's on a trading desk or investment banking or whatever, that the parties who are making a lot of these decisions had upside if the deal flew and a big profit was made, but didn't have anywhere near the same proportion of downside if the whole thing went asunder. So I do think it had an effect. Now, a little bit what happened was, as international banks got more global and got bigger, it became harder for partnerships to compete at the same level and have the same capital bases. And I remember the debate at the time that Goldman Sachs went public, and the sort of winning argument seemed to be, well, the notion of having permanent capital is very important. And their model is to obviously have the public capital and to have the larger capital base, and then try to keep some of the culture by still having a partner and managing director level within the corporate structure. And I would say that's worked to a reasonable degree. I mean, obviously all these firms have their ups and downs and everything, but I would say that concept has worked relatively well. So there's a related theme that I'll touch on just for a second, though, which is, over the years, as Peters & Co. grew and raised its stature, there were various approaches of large investment banks, international investment banks, other independents that wanted to merge or to buy the firm out. And my posture whenever those things arose was always that I'll do whatever creates the greatest good for the greatest number of people here. And if you want me to sign non-competes and golden handcuffs for a certain number of years in order to make a deal happen, I would do that if it's the right deal. But I used to always say, let's not do a deal just to realize a capital gain. Let's do a deal because our hearts are really in it, and we see more potential in the combined company than in staying independent. And almost always, every time the subject has come up, the decision's been to stay independent and to keep going. And, there would have been a time where a capital gain could have been taken by selling the firm to somebody else, but that was not actually the objective, so.
Brett Wilson was your student.
Yeah.
Then you started First Energy.
Yeah.
Do you think that created a more quality product for the banking system in Calgary at the end of the day when you look back on it?
That's also a great question. So let me go back a little bit. So in the early 80s, I used to teach one course of finance per term at the Haskayne School of Business, which I love. And Brett Wilson was doing his MBA, and he was one of my students. He was an excellent student, by the way. Anyway, and I wrote a letter of recommendation for him when he got his first job in investment banking. So, but anyway, 1993, some years later, he and others started First Energy. We were chatting on the phone, and I jokingly used the reference from Shakespeare's play Julius Caesar, et tu, Brute, which is, and you, Brutus, to say, oh, you're among the conspirators. And it was kind of a joking reference. But your question is a very good one, because I do think that the heightened competition in the business, I mean, we never thought of ourselves as ever getting lax or complacent, but the heightened competition in the business, initially with First Energy and then also with others, created a better market. It created better services for corporate clients and individual and institutional clients, and better. It was actually a very good illustration for me of the power of competition, and because the incumbent, which in this case was us, has to kind of decide, well, are we going to rest on our laurels, or are we upping our game here to play hard against and when I say hard, I don't mean in a confrontational kind of way. I just mean to do everything we can to compete strongly. I think that became very important, that we did up the game, and there have been other entrants, and there have been firms that rise and fade, and frankly, the firms that are owned by the chartered banks have really upped their game as well. They have ebbed and flowed historically, but they're much stronger in their focus on the energy industry than they used to be, and that's to their credit. So,
was it a sleepless first couple nights when you found out about that, or were you? In hindsight now, it seems like you guys all get along, but were you stressed at the time, or were you?
We actually, as I say, I sort of had the joking telephone call with Brett Wilson, and I'm sure in all those circumstances, it's never without some disagreement and everything, but I would say felt confident in our ability to compete, felt confident in our ability to continue to serve clients well. All of them, institutional investors, private client investors, corporate clients. We felt confident in our ability, but I would say, so I don't think there were sleepless nights. It was just a strong resolve to make sure that we continued to compete strongly. And initially, of course, I would say, as First Energy was growing, we were both taking market share from other firms. And so it wasn't like all of a sudden it was very adverse for one of us or not. It was, we were both taking market share in the broader market.
The pie was growing.
Yeah, and the pie was growing too. Yeah.
One of the other co-founders of First Energy was Murray Edwards.
Yeah.
Was it pretty easy to spot Murray Edwards as he was on his way up?
Absolutely. So I first met Murray Edwards when he came out of law school, and he had joined Burnett Duckworth and Palmer, and he was one of the youngest partners there. And Burnett Duckworth and Palmer has been the traditional law firm of Peters & Co. since its inception. And I remember vividly when the partner who served as, I'll use the term, the foreman for all of the Peters & Co. files, moved to Toronto to do something else. Jim Palmer phoned me up and said, well, who do you want? And he started naming off a bunch of the senior people. And I said, no, I would prefer I prefer to have Murray Edwards. He is so smart and so capable that, we'd very much like, him to be the person on our files. And then later he and Jim Grennan and Ron Matheson, and Ron's the person with whom I work most closely these days, proposed a joint venture into Peters & Co. to invest in quite a large number of companies that ended up, unfortunately, from the Peters & Co. perspectives, they did so well, so fast, they didn't really need anybody else after a couple of years, because it was, and I think everybody kind of knows Murray's story in that. So, and the same, frankly, is true for Jim Grennan and Ron Matheson too. That worked out really well for all of them. So,
did you have any idea what was about to happen, or you have like kind of an inkling that all these things were going to go well, or was it a total surprise?
I think, well, so at the time that they got going, which was the late 1980s, we were all feeling like the oil and gas sector was coming back. And in, I want to say 86 or 87, I didn't write many research reports, but I wrote a speech which ended up becoming a research report that was called Looking for the Silver Lining, and making the case that the energy sector was about to turn around. So I guess in my heart, I believed that it would. And one of the things, and frankly, we saw it again coming out of the 2020 downturn. One of the things that sort of shocks people is how dramatically the equity values can increase when you're coming off a really weak period where, oil prices have been depressed and gas prices have been depressed, and stock prices are wallowing at the bottom of their range. And, it's happened a few times in my career, but the late 80s was one of those, and 2020, heading into the current period was clearly one of those as well. So
you're smarter than the average Joe.
I've always thought a person's better to not think of oneself that way. I always thought you're better to be humble about what you might think you know. So,
did you ever get bored of a mono industry?
We thought several times over the years about whether to take Peters & Co. into other domains, and the main discussion points were forest products and mining, because they seem to be the most logical extensions. It would have seemed odd to be in energy and high tech or something like that, or energy and healthcare. So those were the ones we thought about. But each time we analyzed it, we kind of came back to the thinking that there are enormous benefits to having such a great focus on a single industry, and having everybody in the firm, when they wake up in the morning, thinking about that industry and all the players in it. And the other thing that gets developed when you're very focused is you create a pipeline of information, of research reports, and of contacts, and of trading information, and all that kind of thing. And that is quite formidable, from a competitive point of view.
You never thought to expand yourselves like a Berkshire Hathaway, your tentacles everywhere in various industries? And
we looked at that as well too. And the thing that we always ended up being cautious about was creating an impression of conflict, or having a conflict of interest, or of having actual conflicts, So one of the things,
I guess it's different in banking.
Yeah. Well, one of the things that we kept thinking about was we didn't want to be in a position where people thought our allegiance was higher to one company because we had an equity interest, or because people were on the board. And in fact, I was probably the strongest proponent internally of getting all our partners off of corporate boards, at least without permission from the executive committee, just to avoid the perception of conflict or that information might be misused or whatever. And that ended up being an excellent idea. But we did think, I'll give you one other illustration, which is, one private equity group out of the East Coast of the U.S. approached us about putting up a sizable amount of capital for us to invest, with the idea that we would put some alongside. And I said, well, it's very kind of you, but we're just afraid of the perception that all the good deals will end up going into that pool, and that other clients won't get the same swing at those opportunities. And they said, well, that's exactly what we want. We want all the good deals to go in here. And the reason they wanted our own capital in was to cause us to be influenced that way. And so they were worried in the slightest about that perception, but they weren't thinking about how it might, negatively impact the balance of our business. So,
how many boards is too many boards?
Oh, that's a great question. I think it's totally a function of how much else you're trying to do. So for example,
10 boards.
So for example, somebody who is skilled and who doesn't have a full-time job anymore, I think they can readily take 3 boards, and some manage 4, no problem. But I think the way boards work these days, and the number of days per year they require, and the amount of prep, and the sort of all of the sort of random events that arise that have to be addressed, I think if you've given up your executive responsibilities and you're predominantly serving on boards, you want to think about not getting, I think, more than 3 or 4. And I've always been, shall we say, less of a fan of corporate CEOs sitting on boards. I do understand the argument that CEOs and other senior executives gain some knowledge and other experiences by seeing how other companies function and their decision-making processes. And so, one board for that purpose isn't, in my mind, probably something you worry about too much. But I think there's a great risk to corporate CEOs getting distracted from what they should really be focusing on, and especially that's true if their own main company is in any kind of distress or suffering major challenges, because I think the shareholders should rightfully be saying, well, why are you spending all this time on other companies and other boards when we've got all the problems we have here? So I think it's very much a function of whether you have operating responsibilities, executive responsibilities, and then secondly, I think the demands of boards have gone up enough that I'm sure there's some skilled people who manage more than 3 or 4 well, but it's not something I would choose to do, so.
You've seen a lot of deals through the years. Critique of all the deals that goes on is that there isn't much value created at times, and it's just paper shuffling. What percentage of the deals have you seen that actually created value for shareholders?
The hard part in answering that question is it partly depends on the time frame over which you consider it,
Right.
and the complication, as I already mentioned, about the energy sector, is that twice a decade on average things go awry for a while and then come back again. So it gets really hard to measure. So, and I also think it varies by company. So I look at a company like Tourmaline, which is, in my mind, a really skilled acquisitor. They buy things that truly fit, that are also of high quality, like their own asset base, and they tend to strike when conditions are tough for the industry and for the target companies. And, they pay fairly in that context, but it constantly looks better when the cycle turns and comes back again. So I think it varies by company. I don't think I have a precise answer, by the way. And I also think it depends on the time frame over which you look at it, because some of the things one that just flashed through my mind was CNOOC buying Nexen. I don't think they think they ended up with a very good deal when they bought that in 2012. And they paid a premium price. But a little bit, the question is, was it the way, was it what they paid, or was it how they handled the company, or how they managed it after the fact, or what opportunities they chose to pursue or forgo? And so I don't think it's always totally cut and dried. And but there's no question that the energy industry has constantly been in a process of consolidation and in some cases, splitting back out again in some cases, as we're about to see in a couple contexts. So I don't think I have a clean answer to that. So
some people think the junior market it started out as a good idea, Canadian oil and gas junior market, but it grew into a bit of a Ponzi scheme in the end.
I think there were many years where there were true excellent returns being made, and some of that, in the late 80s, 90s, early 2000s, some of that was that there were many willing sellers, and they were selling at attractive prices, and the capital was available to the acquirers to go and add value to those assets. So I think there was true value created. First of all, they were buying opportunely, because the seller wanted to sell. And then secondly, they could see what would be done with the assets subsequently. And, Canadian Natural Resources is probably a classic example of exactly that, of being able to see what it could do with assets that others either weren't focused on or not managing as well, or, there's a whole bunch of, there's a whole list of factors, but that's that.
In the good times, lots of capital flows into energy, kind of creates a big ship, I guess, if you will, or a bloated ship, maybe you could say. It seems like some people recognize that, but not all. Did you think to yourself during those boom times that we got to slow down here and manage capital better? Or was it everyone was making so much money, it just was a second thought?
I always try to look at the underlying economics of what the companies are doing, and one of the things I find encouraging about the energy sector right now is that the underlying economics of what many of these companies are doing are excellent.
Yeah,
and,
exactly.
and in shorthand form, quite a number of companies that are on their exploration and development programs are getting 3 to 6 month payouts, and they're compounding the capital growth at a very high rate, as a result of that. So the times that make me nervous are when payouts get extended and multiples are high, and they might be justified, but they might not be by future events. So I feel more comfort in the environments where the fundamental economics of what they're doing are very sound, and in all fairness, we have to recognize it could change again, and it could change for the better or it could change for the worse. So, but one of the great parts of the way the industry has now evolved is that that much of that is able to be shut on and off as conditions dictate. One of the things we've chatted about is I think the era of large-scale additions to oil sands projects or new oil sands projects is probably behind us for the whole litany of reasons that everybody reads about in the newspapers. So that means the existing projects are cash flow streams out to the future without huge amount of reinvestment risk. Those cash flow streams are long-lived, but won't last forever, but they're very long-lived. And then on the conventional side, what you have is excellent exploration and development, very quick payouts, high internal rates of return, but it can be modified, that if all of a sudden oil prices fell dramatically, that spending is not like committing to a multi-billion-dollar long-lived capital expenditure. They are, those are in manageable bites, and they can shut off. So it's part of what's driven the debate in the U.S., where Biden and Amos Hochstein and others are pressuring the oil and gas producers to invest a lot more, and the oil and gas companies are pushing back, saying, well, you're the ones that actually are trying to shut off the oil and gas industry and replace it all with renewables. We've got to look at what our useful life of our assets and our rates of return are. And by the way, our investors actually want it this way. They want the returns on capital. But, there are many facets to these discussions, and it gets too simplistic to just look at one or two things, because there's lots of different things going on at once. So,
in the context of boom and bust, you've seen lots of booms and busts. Right now, it seems like we're kind of growing again in Canadian energy, and everyone's focused on actual genuine returns and that style of business. Where do you think we are in that cycle now? Or is it too hard to predict? Are we kind of on the up now, or is it?
I think we're maybe in the fourth inning of the current cycle. I think we've got a ways to go, and the reasons for that are many, but
in simple terms?
Well, the biggest ones are global underinvestment in energy supplies. So that applies to oil and gas, but also other kinds of energy, and it applies to electrical distribution and other things. It's just been massive underinvestment, really, for close to the last decade, relative to what are now the needs, and that's collided with the fact that we've rebounded out of the pandemic for the most part. China's still a bit of a question mark, but we've rebounded out of the pandemic. We have the Russia-Ukraine problem. We have low inventories. We, have relatively slow additions to new reserves of oil and gas. And we've got the energy transition is taking way longer than the optimists assumed that it would, so therefore, people who assumed that energy demand or oil and gas demand would be dramatically lower by now have been disappointed, because though the wind, solar, other renewables are growing at a fast rate, they're doing it off such a low base. It takes a long time to make that transition. So.
Everyone's scared last week or this week because oil's down at 70 again, but I suppose that's just the nature of it. It's going to go up and down and can't be at 100 forever.
Yeah, I think that's right. And I think there are two supports to oil in 70 to 80 range. One is, of course, that the U.S. has said it's going to refill its strategic petroleum reserve at 70, or 70-ish. And probably they should do that, because they have run the strategic petroleum reserve down dramatically for what wasn't a true emergency, but was really more a means of politically trying to influence the vote in the midterm elections, so get the gasoline prices down, because that's one of the real key data points that matter to voters and consumers. So there's that one. And then we have OPEC, or OPEC Plus, which doesn't really want to see prices below 80, so I think they're reluctant to make too many tweaks to their volumes, but the short answer, I think, is that they also have enough influence on the market that by, for example, curtailing production, they could move the price back up as well. So I think those are two supports to price, and the other is the natural decline rates, that if the world uses roughly 100 million barrels a day of oil and that declines at 5 or 6% per annum, that means we have to find 5 to 6 million barrels per day of oil just to replace the decline in the last year's production. And that's a tall prescription with the amount of capital spending that's going on right now. So that's another support to oil prices. So, we just have to constantly be looking at the supply side, which, is additionally complicated by the fact that, the Russian crude isn't exactly desired by a lot of folks. And the demand side, which seems to have held in very well, through the pandemic and then through the recovery.
Up to this point, what's been the most favorite part of your career? Most stimulating? Most enjoyable? Maybe right now.
You're probably going to think I'm ducking this question because I'm hard pressed to think of a part that wasn't great, but they were great in different ways. So when I first got in the business at Merrill Lynch and at Wood Gundy Limited, it was just the thrill of learning and all of the trying to understand how deals worked and the relationships worked, how the investment banking business worked in the Peters & Co. years. It's just so many things, helping to build a firm, helping so many energy-related companies with their financing and mergers and acquisitions, and then more recently, I feel really lucky. I've been at MATCO as vice chairman almost 9 years now since I retired from Peters & Co. And it's worked out great. And we invest in lots of interesting things, and we're in a good cross flow of information in the spot we're in because we have diverse investment interests and we're able to see lots of transactions, see lots of research, and make decisions accordingly.
Did you think of it in terms of making work your vocation? When I met you, it was a Saturday and you were working.
Yeah.
You haven't had to work for a long time, but it sounds like it's just something you enjoy.
Yeah, I do. I find I don't necessarily fuss about what day of the week it is, or I was still here at 8:30 last night. Awesome. Sometimes there's just a lot going on, and so I just adapt to whatever it is that's happening. And there's the old saying that if you really love what it is you do, you never work a day in your life. And I would say it's not quite that extreme for me, but it's certainly I certainly don't go to work dreading it or any of that kind of thing. And I think people who have that benefit, that they go to work every day doing something that they really enjoy and it doesn't feel like an onerous task, are very lucky. And I've known people who, particularly in bureaucratic kind of jobs, that start looking forward to retirement in their 40s, and they've really kind of got out of gas and that kind of thing. And I feel like that's a really unfortunate waste of decades of a person's life if they're in something that they feel stuck in, or reluctant to take the risk of moving out of, but don't really like it, and they're just hanging on to get the pension at the end of the day.
You had to work really hard in investment bank. Did you ever get burned out?
I don't feel like I ever got.
How'd you deal with that?
Really burnt out. Well, I think I always tried to be analytical about the issue. So to give you one important illustration, we were growing fast in the 1997-98 period. I was serving as chairman of the Investment Dealers Association of Canada, and I was the first one from Alberta to be in that role, which is a fairly time-consuming volunteer job. We had tons of business. We were growing fast, and I felt like something was wrong. So I sat down one weekend to analyze it like a business case and say, okay, well, what's wrong here? and I decided what was wrong was way too much stuff was coming through me, that I was, in terms of both the management of the firm and, hiring, firing, compensation, regulatory, review of accounting, banking, all these kinds of things. And there were other people involved in this, but there was way too many things I was signing off on, and plus origination of financing and merger and acquisition work. and the execution of that work. And we had many young partners coming along, but there was at that time too many things going through me. So my analysis said, and I went to our executive committee and said, okay, I think we need to go out and bring in another partner who's sort of like me, and the objective will be to hand that person half the management problems and responsibilities and half of the corporate finance and investment banking responsibilities, and see what we can achieve then. So anyway, I created a short list of 2 people. I talked Ian Bruce, who was then the head of Western Canada for Scotia McLeod, into coming and joining us as vice chairman, and that worked brilliantly. It just as I described it, that he took enough of the responsibilities that it reset us to being able to grow. And so we grew dramatically from that point again, because we'd already grown quite a bit, but I could see we were going to have trouble getting to the next level if we didn't get more resources and in effect buy ourselves the time for the next generation of senior managers like Chris Potter and later Cameron Plewis and that to come along, that they weren't perhaps ready for that level of responsibility yet, but they would be, later on. And so that analysis and decision was, I would say, a really important one for the firm. And, you ask about how you feel about your own work, everything. Like my feeling about my own work, once I didn't have to do so many things, life got better, life got considerably better. So,
do you remember the Halloween massacre? Halloween 2006?
Oh, yeah. Okay, yep.
What were you doing that day when you found out?
I can't remember. It actually didn't surprise me, that when it occurred, yeah. And the reason was...
Okay, maybe what was the Halloween massacre for anyone that is listening?
So the Halloween massacre was essentially a change in the rules on royalty trusts. And so what was happening was a fairly decent chunk of the energy industry and other parts of the Canadian economy were changing from corporations into royalty trusts, and the income was being paid out straight to the investors, without an intervening level of corporate tax. And governments were getting worried that if the trend continued, that it would undermine the tax base of the country, and there was an additional factor, which was, that Canadian royalty trusts were able to pay out income to people, for example, in the United States, and they would not, in Canada, you were forced to treat it as a regular income. In the US, they would treat it as dividend income. They would pay withholding tax, which they could recover against their dividend tax of like 15%. So the value of assets were getting bid up, not solely by Canadians who were getting the income stream, but also by people outside the country who were seeing the benefits of it. And so the Canadian government was feeling nervous about it. And I didn't foresee the exact timing and all that kind of thing, but there'd been various discussions going on with both the major political parties about what the consequences were of this and what the potential solutions were. And then all of a sudden they just decided to, okay, this is it. Because I think they started to worry some really large corporations were going to get rolled into royalty trusts, and then it would become much harder to reverse. There was rumors of banks or major industrial companies rolling into becoming royalty trusts. And that, from the point of view of the country's tax base, became quite worrisome to them, so.
I had John Bruce on the podcast.
He was very much live in those discussions. Yeah. And John is extremely smart about those kinds of issues. And I remember back to those days that he had it thought through very analytically and well as to where this was likely to go. So as I say, there have been various discussions with both the major political parties on what the trend was and what the potential fixes were. So it didn't totally surprise me, but as with many things, companies and capital markets adapt though too. We now have a model that doesn't have pre-tax income going out, but it has significant dividends being paid by many Canadian companies. Yeah.
When we had lunch, you said old money in Calgary is last week. Do you think that meritocracy still exists in Calgary?
I think it does to a stronger degree than it does most other places. That was always my joking reference. Old money in Calgary, somebody who had it last week. Yeah. And that is sort of reflective of the historical wildcatters and in the oil patch and the entrepreneurs. And it's a joking reference, but I think it's a good one, so.
Do you think it still exists?
I think it does. I think that, like everything, as things mature, you get larger companies. They have a bigger base. They're not as risky. So I think it is different now because the proportions have changed. The proportions that are in larger capitalization companies and more stable and secure is much greater than it was, when I started out a few decades ago. So, of course, but I still get a strong sense of entrepreneurial spirit, and I get a strong sense of people wanting to innovate things, and I think that's very exciting.
In terms of Alberta and oil and gas and business in general, have you seen a shift over the years? Oil and gas seems to, it's not a sunset industry, but it maybe is not as prominent as it used to be. Have you seen a shift in, I guess, the economy of Alberta in a good or a bad way, or is it just evolving? How do you look at it? Well, in that sense,
I think to a certain degree it's a natural evolution. The only way that oil and gas, we should separate oil and natural gas, but let's talk about oil first for a second. The only way oil could grow significantly in volumes, given the geological predisposition of Alberta, which is more oriented to oil sands and natural gas, the only way it could grow really significantly is if oil sands projects were to be reinitiated, which, as I mentioned, I don't think is very probable for a whole bunch of reasons. And then the natural gas side, I still think has considerable growth potential. And we do have LNG Canada coming on in 2025. We do have the prospect of a second phase to LNG Canada, plus some other projects. And I think the U.S. will be a continuing source of demand for Canadian natural gas, assuming we can figure out the ways to get the gas there, in part because of their own use, but also their growing need for their own LNG plants and for their exports to Mexico. So I think all of those things bode well for the natural gas industry.
There's still room for growth.
Yeah, still room for growth, but we just have to be realistic about the fact that the oil side probably doesn't grow too dramatically. The conventional light and heavy crudes more than replace themselves, but that's not a major source of growth in production. The natural gas side can continue to grow, but it needs to be in a measured way, because periodically we seem to, produce more gas than we have the capability of handling, and then we drive the price down for a while. And so I think that all has to be done thoughtfully and in a measured way by the companies. As to the balance of the economy, we have agriculture, we have a lot of major distribution centers. We have certainly the technological investments in and many startups and that. I think all of that's very exciting and good too. And there will be failures, and just like in the early days of any other industry, but it creates a vibrant business environment, and I like it.
I said this on the podcast before, but I think one thing that's cool about a state like Texas is they seem to have everything: tech, agriculture, oil and gas, SpaceX. They have everything. Maybe Alberta could position itself someone like Texas, where they seem to have interests in all these different industries, hopefully. I think it goes back to being thoughtful about in which industries Alberta has true competitive advantage, and where are we just trying to make a business happen in a particular geographic location. But in all the things where we have true competitive advantage, which includes oil, natural gas, petrochemicals, agriculture, some of the new technologies and such, I'd be very, very optimistic. And Texas has the benefit of more industries, more people, and of course, there's the constant
attraction in the U.S. of relatively low state income tax rates compared with California or other states. So that's been a huge draw for them.
You view art as an investment opportunity.
I do, but I always suggest to people to think of it very carefully and to do a whole bunch of homework before treating it that way. And I always worry when I talk about art as an investment in encouraging people to think that, well, anything I buy will go up significantly in value. And that just purely isn't the case. But, there's some great illustrations, like John Whitehead, who was one of the two senior partners of Goldman Sachs. As he got late in life, one of the things he said was, when I look at my own asset base, it's become heavily overweighted in one asset class, and that's art. Yeah. And I think that's sort of an eloquent statement when the senior partner of Goldman Sachs, who can invest in anything, you're sitting on top of a enterprise which has everything, every opportunity shown to it, and he ended up with an asset base very weighted to art. And another illustration was, if you go back, further, is John Maynard Keynes. The Financial Times did an analysis of what his art collection, besides being an economist, John Maynard Keynes was an active stock market investor, but also an art aficionado. And by far his biggest asset would have been his art collection, if he'd been able to live long. And so I do think there are many opportunities, but you also have to be careful. And there are, like in any domain, people who are dishonest or, scammers and that kind of thing. So you have to be extremely careful. But generally the big analyses that are done by folks like Deloitte and a couple of academics named Moses in New York, they tend to show that the long-run compound returns of investment-grade art are a little less than they are for the stock market, but you get the enjoyment of the art as well. But I put a lot of emphasis on the words investment-grade.
Right. That's the trick.
Yeah, you want to be thinking in that domain about art which has an actual market other than the dealer who sold it to you, that has an actual outside market, potentially an auction market. And in addition, it meets a whole bunch of other criteria, the quality of the work and its condition and its, what it depicts and, what its provenance is and all of the other, variables that are important need to be analyzed. You need to think about it. So I often say to people, if they're interested in having pictures on the wall, paintings on the wall, or sculptures in their home, the amount involved is below what for them is their threshold of significance. And when I say threshold of significance, I mean the dollar value where you don't have to actually care if it goes up or not. Then I think you can be a little more liberal. But as soon as you start putting bigger amounts into the art market, you need advice and you need research and you need to be able to, but it's totally fascinating. And there have been some spectacular gains in art. And we just recently saw, Paul Allen, one of the founders of Microsoft, selling $1.5 billion of art at Christie's in a couple nights, so that was a very successful investment for him. Probably not as good as Microsoft, though. It wouldn't have been as good as Microsoft.
Yeah. Maybe don't pay $400 million for questionable Leonardo da Vinci.
Yeah, exactly. Yeah. We covered the waterfront?
That's a great conversation.
I would say,
advice to an entrepreneur. What would you tell them? A young entrepreneur, what advice would you give a young entrepreneur?
I would say that many of the things that make an entrepreneur or a business person successful are relatively common sense things. And I would say that, first of all, trying to think clearly about your opportunity, but then also thinking both with the people you manage and customers and everything, how you treat them and how you operate, So I would say entrepreneurs who can see what the proposed transaction looks like from the other person's side, who can look for a balanced outcome. Everybody likes to make profit, but a balanced outcome for whether it's customer or partner or entity being acquired. I think those are all good things, and treating people as you would like to be treated. And, a lot of those things are intuitive, but they also should be said, that many of those things are personal characteristics that are in some respects more important than anything else. Treating others well, whether they're working with you or they're your customers. I think those are all super important. And I would say of the entrepreneurial opportunities that I've looked at and that we've looked at here, the biggest flaws tend to occur in either misassessing the market or misassessing the competition. And there's lots of things that go into starting any kind of a business. But I would say, so first of all, getting straight on how you want to conduct yourself and conduct your business, I think, is really important. But then secondly, you go through all of the analysis of what it is that you're doing and want to do. And I would say the most flaws in things we look at are either that the market hasn't been analyzed correctly or the competition hasn't been analyzed correctly, including prospective competition. So.
That's it.
Okay.
Thank you very much for your time.
Okay.
I really appreciate it.
My pleasure.
We'll end it there. Okay. Thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.